Are you surprised to see how quickly and how strongly the markets have rebounded here, given still the large uncertainties in China?
I'm not totally surprised. I mean, it's kind of an unknowable thing in real time, but the market ran up 17% in 4 months, which is a huge run up. And so it's kind of hit a little bit of a wall here. We're kind of back at the highs, but we fell 4%. And I think what's happening these days with investors that when they want to hedge risk, which of course is what they've been doing, it's been easier just to buy bonds than sell stocks because the path of least resistance for the equity markets have been up for the last 11 years, and for bond yields it's been down. So rather than sell your equities, which have kind of tended to go higher, it's been easier to buy bonds, which is why we saw the kind of the collapse in bond yields from 195 or so to 150, and now we're back a little bit higher.
So what would you tell investors to do now that we're back at the highs?
You know, I always say the same thing. If you have a diversified portfolio, you don't really need to do very much other than to rebalance at times. You know, a 60-40 portfolio since the beginning of 18 has matched all the upside of the S&P, but only has produced about 60% of the downside. So maybe at the highs, someone should have rebalanced because that 60-40 may have turned into a 70-30. And if the S&P, let's say, goes to 3,000, which technically would not even be a big deal, even though it will be a 10% decline, maybe a rebalance out of bonds into stocks is in order. But other than tweaking the edges, I don't think there really is that much to do here.
Brian, what about you? Multi-asset strategist. How does stocks look at these levels?
Yeah, I guess it depends upon which stocks that you're actually looking at. On my team, you know, broadly speaking, we're still bullish on equities overall. So if you want to think about, say, the Nasdaq, we actually would prefer riding the momentum of tech as opposed to being in the S&P 500, just because we think that there's some good earnings momentum as well with a number of those companies that are in the Nasdaq versus S&P. But we actually are a little bit more optimistic about outside of the United States as to the extent to which this sentiment can spill over to other jurisdictions as well, especially emerging markets and Europe. We think that there's some very good long-term value opportunities in EM and in Europe, and that we could be at a point in which you get a reversal. Obviously, that's been a tough thing to call, but you know, with earnings season underway, looking better than expected, and actually some of the global PMIs in the emerging markets taking a turn for the better, we think that actually provides a good fundamental backdrop for overweighting EM and Europe relative to the U.S.
Jurrien, 10-year 166 today. BNP Paribas today says we're going back to 195. So does the market have one eye on yields? And is that the reason why getting or surpassing these record highs is going to be a challenge?
I think surpassing the highs is not necessarily going to be a challenge, but that rally's been put on hold. And as your other guest said, you know, the kind of the EM cyclicals rotation that we started seeing last October has been sort of put on hold. And so my guess is markets are going to hold on here until we actually see the earnings recovery that has been so priced in actually materialize. And obviously, EM,
and that's going to come later than we thought.
Exactly. And so on the bond side, you know, I think the bar is very high for the Fed to cut rates. I really don't think they're going to. They don't want to. We would need to see a serious dislocation financially. So in that sense, the bond market needs to reprice itself, like the forward curve is pricing in 2 rate cuts. I mean, I really don't think that's going to happen. So back towards 2%. I think is doable and really not damaging in any way. I don't think a 2% 10-year yield is going to really cause the stock market to blink an eye here.
Yeah. Brian, do you agree with that assessment that we have some cushion up until 2%? And do you expect volatility in the spring if Powell means it when he says he's going to take away some of the repo support?
Yeah, that is something really to watch, is if Powell is serious about taking away that repo support. Perhaps what they're going to do is extend the repo support, and actually when they wrap up their assessment, their strategy assessment, is create some sort of permanent facility for repo support, which I think would allay a lot of people's fears instead of just taking away the support and then adding it back at a later point. So the timing of this, I think, is a little tricky for Powell to navigate. But broadly speaking, we think that for the 10-year Treasury, we are looking to see whether or not we move above 1.9. It's one of those situations where you kind of draw a chart and you look at, well, maybe we had some support with yields around 1.5-ish, some resistance at 1.9. But if you get above 1.9, 1.92, suddenly that resistance can become the new support. And then you can move back up rather abruptly, as we've seen in the past. So my team, we're actually monitoring it very closely, not necessarily positive, negative. We're table-thumpingly neutral at this point on yields, but that can change if we suddenly break above 1.9% on the 10-year Treasury. There's not a lot to suggest that it should move that much higher soon, but as we've seen, if the data suddenly gets really bad, maybe the yields could move lower. If we suddenly get inflation numbers picking up or growth is proving to be a lot more resilient, then we could see those yields move materially higher. So it's one of those situations where it's almost like there's sort of a distribution of risks out on the tails. And so we're just sort of threading the needle at the moment with the yields, it feels like.